Ladies and gentlemen, good day and welcome to Torrent Pharma Limited Q3FY22 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sudhir Menon. Thank you, and over to you, Mr. Menon.
Thank you, Nirav. Good evening and welcome to Q3 FY22 Earnings Call of Torrent Pharma. Very quickly, the financial performance highlights during the quarter is as follows. The revenues were 2,108 crores, up by 6% on YOY basis. EBITDA was at 585 crores, down by 5% on a YOY basis. The profit before tax was at 357, same as corresponding quarter in the previous year. Net profit after tax was at 249 crores, which is down by 16%, essentially because of the tax change which has happened during the year. Profitability for the quarter was impacted due to higher than anticipated price erosion in the US-based business, coupled with under absorption of certain amount of plant overhead and certain one-offs which have come during the quarter. We have rolled out cost optimization initiatives and we are confident to revise the margins in the shortest possible time. Today, the Board of Directors have recommended interim dividend of 25 rupees per equity share. I would now hand over the call to Aman to take us through the India business performance during the quarter.
Thanks, Sudhir. India revenues at 1072 crores grew by 15% versus the market growth of 6%. And even as per the AIOCD data, Torrent's growth for Q3 was 15%. Growth was driven by robust performance of top brands in all our focused therapies. PCPM for the quarter was 9.9 lakhs with an MR strength of 3,600. Torrent continues to focus on brand building and specialty approach and has 16 brands in the top 500 of the IPM, with 11 brands more than 100 crore sales as of March-December 21. I'll now hand over to Mr. Sanjay Gupta for the international business.
So I'd like to start with Brazil. Brazil Q3 sales were about 135 million, up by 8%. Year-to-date sales in Brazil were about 353 million reais, up by 13%. Growth was aided by market growth together with performance of top brands and new launches. During the quarter, Torrent has launched a new division in the CNS segment. Further, Torrent has recently launched Rivaroxaban, which has a market size of about 800 million, which is the largest market in which we would participate in Brazil. With resilience in market growth and launch of a new division, we expect continued strong momentum in Brazil growth. Moving on to Germany, Germany sales were 28 million, down by 6% on year-on-year basis. The market growth in Germany continues to be muted. For the calendar year 2021, the market was essentially at 0% growth. The tender segment is also witnessing increased amount of competition. For the US, sales were 31 million, down by 21% on a year-on-year basis. Sales were lower due to price erosion in the base business and lack of new approvals pending re-inspection of facilities. The manufacturing facility at Levittown, US was inspected by the US FDA during December 2021 and they did not give any observations. As of December 31st, 2021, 51 ANDAs were pending approval with US FDA and 7 tentative approvals were received. 2 ANDAs were approved during the quarter. I would like to conclude by highlighting that the growth momentum continues in branded generic markets, including in our India business. Delay in re-inspection of US facilities, together with price erosion in certain one-offs, have adversely affected the US business. We are confident that the cost optimization measures initiated during the quarter would aid us in reviving margins in the coming quarters. Now we can open the call to questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. So you alluded to certain one-offs during the quarter on the US business in specific or on the overall basis. Can you quantify that?
Oh, yeah. So when I said one-off, Tushar, there are 2 or 3 items I would like to highlight. So number one, during the quarter versus quarter 2, there has been an increase in the freight expenses, almost by 1%, I would say. This is something which has happened because of this whole Omicron surge related disruptions which has happened, which we feel should come back in a quarter or 2. So that's something which has happened this quarter, around 1% impact. The other 1% impact is there were certain failure to supply provisions we made again for the US business on one of the products where we had contracts and we decided to discontinue that particular product. So that is another 1%. And what's actually happened this quarter is that the actual manufacturing volumes were much lower than what was planned, which led to under absorption of overheads, which has impacted the margin by almost 1%. So all in all, 3% is something we believe that it's a one-off for this quarter, and we should come back in a quarter or 2. That's the one-off which I was talking about.
Got you, sir. Got you. And with respect to this failure to supply, basically the product economic viability was much lower. It seems that it was better off to take provision for failure to supply rather than supplying the product. Was that is that the logic for this?
No, not really, Tushar. Tushar, we had some issues with respect to this product availability, and therefore we decided to discontinue. In that process, certain contracts which were there had to be cancelled, and therefore we've made provisions of failure to supply, assuming that this would come and hit the P&L.
Understood. And just lastly, with this run rate and given the lack of approvals basis, the inspection not happening, so this can be a sustainable run rate to go by, or you see further headwinds on the US business in particular?
Yeah, Sanjay, you want to take that?
Yeah, sure. So generally, until we get new approvals, we would expect the share of the US business in Torrent revenues to continue to decline. We have a few set of approvals expected in Q4. I would say the biggest among them is Dapsone, which is a dermatology product, roughly about $135 million with 2 players. So if that approval comes through as expected on February 18th, that would provide a boost to top line. But other than that, the bigger boost, we will have to wait for the plant inspections to happen, right? So because we have about more than 50 areas waiting for approval, out of which about 27 have nothing, no pending issues except facility clarity.
But can you just rename the product? I missed the name of the product.
The one we expect on February the 18th is the Dapsone, D-A-P-S-O-N.
Yeah, got you.
Yeah, it's a derma product. Yeah.
All right. That answers my question.
Thank you.
Thank you.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Good evening to all. My question is, like, all the 3 things that you said, which is about a percentage each is part of gross, impact of gross margins. Would that be correct?
No. So only 1%, which is under the no. I think all of them are basically middle line, Prakash.
No, so because I see 2 things happening, right? So one is your gross margins have gone down. That is one. Second is your other expenses has also gone up. So which is sitting where? Because there is a clearly 200 to 300 basis point miss on the gross margin and about 500 basis point lower in EBITDA. So could you just help us understand? I mean, gross margin could be this, the under absorption that you spoke about, and provision of US supply, so 2%, and freight would be part of other expenses, right?
Absolutely. So freight and failure to supply provision is in the middle line. As far as under absorption of overhead is concerned, again, I would say some part would be in the middle line and some part would be in the gross margin, because essentially, I think the inventory valuation which happens along with material cost and overhead. So I would say 2.1% in gross margin is surely because of the price erosion which has happened in the US. Out of the 2.4% lower gross margin compared to Q2, and the rest would be, I would say, the under absorption of overheads.
Okay, and this other expenses, even if we add back this, still it is on the higher side. So what do you think is a sustainable number for this piece?
No, so I think 2% is what I said, right? I mean, definitely, let's say 2.3, 2.4 is definitely what we spoke about as one time. This should get corrected over a period of time. There's no problem from that perspective. In addition to that, I think there's an increase in R&D spend by 10 crores. So I think to that extent, here and there should be fine. So definitely 2.2, 2.3% should get reversed from the other expenses, is what I believe. The other is plus minus 10 crores here and there, Prakash.
Okay, and this you're saying would be like Q4 phenomena, or it will take a couple of quarters to reverse?
So definitely Q1, I feel I'm very positive, is what I can say. But Q4, we should see something happening. I mean, I'm not too sure about it, but definitely Q1, we should see these things happening.
Perfect. And my second question, sir, is on, the India business. So very strong growth. How are we seeing, in terms of new launches, in terms of any big launches that we anticipate for next year, especially in diabetes, etc. And where are we in terms of new launches for next year?
Yeah, so in Q3, we've had about 10 new launches. Some of those would be combination and extensions. Some would be in sizable markets, so the opportunity would be fairly large. And Q4 also we plan to launch around 10. Out of that 10, we've already launched 2, one of them being dydrogesterone, which is a large opportunity, and second is molnupiravir.
Yeah, and any growth expectation for next year?
So if we look at Q4 at least right now, what we hope is that the IPM growth, which is at 6% in Q3, that should increase sequentially. So upwards of maybe 9-10% is what the IPM hopefully should deliver, and we are confident of maintaining this growth from rate higher in the market. Next year, of course, there's been a base effect in Q1, so growth reported may not be as high, but underlying growth we believe should continue at 10% of the broader market, and our growth should be higher than that as for this quarter.
Okay, perfect. Thank you and all the best. I'll join back with you.
Thank you. The next question is from the line of Sriram Rathi from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. It was just 2 questions. One on the gross margin. So gross margin is down by almost 2 to 3 percentage points on QOQ or YY basis. I think one reason, of course, is the US generic pressure, but I mean, there has to be something more to that, right? I mean, so what exactly would have been the reason for this?
No, Sriram, the net drop versus Q2, if we look at it, is around 2.4%, of which we are saying 2.1% is because of the price erosion, which has happened in the US. So almost 19% price erosion we've seen this quarter happening versus Q2, not on YOY. So that's the major component. And as I said, some portion of the under absorption which has happened. Right. So that effectively talks about that 2.4%.
So how should we look at this number going forward? I mean, because the US continues to enter pressure, so I mean,
no, absolutely. No, I think that's a good question actually. So US price erosion is something which will remain, right? At least for Q4. The way I look at from next year perspective, is that the recovery would definitely happen in terms of the price increases which we would be taking on the branded generic piece. That's something which for sure is going to happen as far as branded piece is concerned. And I think as a portfolio, the share of the total revenue, 65% is branded generic businesses. So if you calculate back of the envelope, I think 1 to 1.2% of this should get offset with the price increases which will come in branded generic prices, is what I believe. Plus, what we also expect is if the US business, the US FDA inspection is happening next year, there are few launches which can start happening next year. Not all the products would be giving a better margin or a higher realization, but there would be some products which would give. That's point number 2. And point number 3 is there's already a few products from the ER&D, the external R&D pipeline, which would start coming in actually for the next year. And we don't see problems for those products coming in. And those could also help in pushing up the margin. So all in all, I personally believe that most of this drop which has happened in quarter three in the gross margin should come back in the next year.
Okay, got it. And secondly, on SG&A expenses, I mean, of course, there is significant increase, almost, 15 to 20% increase in absolute amount. Explain the reason for that. So, I mean, like we were doing 350 to 370 crores kind of expense every quarter. So from Q1, assuming that freight cost normalizes, so should we be back to that kind of number, or it will be on the higher side?
Right. So there are two main impact items, Sriram. So as I said, 1% is because of that freight, right, which is, let's say, 1% of the revenue is 21 crores. So out of 542, 21 is contributed by this incremental freight which has come in. So that should normalize, is what I said, by quarter one at least next year. The other impact which I said 1% is the failure to supply provisions which we made in quarter three, right? So another 1%, that's also 21. That should also come back. I mean, that impact should not be there in the future quarters. So all in all, if I put these two items together, then we are talking about a 42 crores, right? So 542 becomes 500 against an average of 490, which we were clocking in the previous quarters. So 490, 500, 505, I think that should be the base number on which next year, I believe at least 8 to 9% increase is something I would take on a normal basis.
Right. That's helpful, sir. Thank you so much.
Yeah.
Thank you. The next question is from the line of Damayanti from HSBC. Please go ahead.
Hi, thank you for the opportunity. So my question is again on gross margin. So you explained majority of decline is due to the price erosion part. How about decline due to raw material price increase, and how do you see this part for next few quarters, the raw material price inflation?
No, Damayanti, you're right actually. So I think the drop in margin which was explained was versus quarter two. So if you ask me whether the raw material prices has further gone up in quarter three versus quarter two, maybe not. I mean, I don't see that kind of an impact. But yes, I mean, during the year, we've seen some increase in prices, both API and inactive raw material. And some of the inactive raw material, almost 50% price hike. So as a portfolio, since we are more focused on the chronic segment and the dependency on China factor is quite low from that perspective, because I think most of the price increases we've seen on the acute side, not on the chronic side. But I mean, if I look at from an overall perspective, yes, I mean, the gross margin could have got impacted by maybe 0.8 to 1%. But that's there in quarter two as well as quarter three, I would say.
Okay, so sequentially, we haven't seen additional, I'll say, impact of this raw material price inflation. You said 0.8 to 1% on a YOY basis, right?
For the year, yeah.
Okay. Okay, that helps. And my second question is, do you have any visibility on timeline for FDA inspection of the pending issues at Dahej and Indrad? And what about the supply situation from Levittown plant?
So actually, we don't have any visibility on inspection of Dahej and Indrad. So the supply situation from Levittown is by the March of 2023, we should have about 10 products on the market. So and well on the way to generate about between say $6 to $10 million of annual revenue.
Sorry, sir, I just missed. So by fourth quarter, we should be going back to the 8 to 10 million kind of run rate from the Levittown plant.
Correct, with about 10 products on the market.
Okay. Thank you. I'll get back in the queue.
Thank you. The next question is from the line of Neha from Bank of America. Please go ahead.
Yeah, thanks for taking my question. I have two questions. First, in your opening remarks, you mentioned, cost optimization steps that you would plan to take. If you could just give us some color on what these would be. And my second question, if I remember correctly, we'd indicated that we could potentially look at investing back in India, to increase our sales force. By when should we expect that, or do you think we can support growth in the India business with the current sales force? Thank you.
Yeah. Neha, I'll take the first question and then probably I'll give the second one to Aman to answer. So when we spoke about cost optimization, that was more in terms of the plant overheads, where we've done some amount of work on that, and what we are doing is that we are trying to maximize the volumes at one particular plant. And as far as the other plant is concerned, we are trying to cut down on the shift for that particular plant. And in this whole process, also optimize the volumes for different geographies in such a way that at least some part of the plant overheads can be optimized. That's what we said, that the cost optimization measures have already been undertaken. So that's something which you'll start seeing as far as the gross margin is concerned, definitely from quarter one of next year.
Yeah, so for the India field strength and expansion, so we would be undertaking some level of expansion during this quarter, which has been initiated already. I would say about half of the total plan would be implemented by end of Q4, and the second half would be probably by the end of H1, looking at something about between 400 to 500 reps addition to the current field force.
So in which case, there would be some additional cost pressures that we will see because of this field force addition, right? So that would be an incremental expense over and above, so some of the price increase will be offset by the higher employee cost that we could see. So is that the right way to look at it?
Sorry, Neha, can you repeat your question?
So the 400, 500 additional people would increase our, employee cost. Which would be another cost headwind, a margin headwind, for next year. And therefore, the price increase that we would see in India would partly get offset by this, cost increase. Is that the right way to look at it?
It's a logical way to think, but the other thing which I have been talking about is that on an overall basis, you'll see the operating leverage kicking in, right? Because the top line would be quite much faster than the middle line. So yes, to a certain extent, it's a logical thing that the price increases will help in offsetting this particular expense, which will not be substantial. It should be less than maybe 0.5, I would say. Other expenses also playing out, there will be operating leverage kicking in. So I think on an overall basis, it should not be a major impact on the overall margins. It should get offset against the incremental benefit which is going to come.
Understood. Thank you so much.
Expenses tend to be more gradual when it comes to Q4's expansion. So over maybe a 9-10 month period, would it be really in full implementation rather than upfront?
Got it, sir. Thank you so much.
Thank you. The next question is from the line of Abdul Purnawala from Elara Capital PLC. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. So just would you be able to provide the breakup of the 51 ANDAs which are pending with the US FDA? As to how much would be filed from Dahej and Indrad, and how much would be third party in these?
So the exact number we won't be able to provide, but the majority of them are from the 8 Mindra. So I'd mentioned about out of these 27 have nothing pending except the facility, right? So we should expect those approvals in quick speed after the inspection. So generally the time frame from the FDA is, if you can assume that the inspection takes place in month 1, you would get the EIR, if everything goes well, about 4 months. And then normal time frame for FDA is about 90 days after the EIR to start approving pending ANDAs. So, I mean, if the inspection takes place next month, 8 months after that, you can expect October, November time frame products to start getting approved.
Sure. And so my next question is on Germany. I mean, we saw last quarter in Q2 as well, reported a close to 4% decline. And this quarter again, we are facing some headwinds. So going ahead, how should we view this business, especially on the tender side? What is the kind of growth we should build up for next year? If you could help us guide on that.
Right. So last 6-7 quarters, we've seen sales, vary in the range of between 28 to 30 million euros per quarter. So it's been kind of stagnant. The delta is very little. It's usually in this range between 28 and 50. And there are 2 types of factors behind this. One is I would call more market-related factors, and one is Torrent-specific factors. So market-related factors is overall the market has been flat. So usually German market used to grow between 2 and 3%. So that has not happened. 2021 we saw 0. Second market-related factor is we've seen new players come in and some kind of price erosion. So over the last 1 year, I've seen about 7% price erosion. So it's not yet the US, but it is becoming like more competitive and more price sensitive in Germany. So that's on a Torrent specific factor, we've noticed 2 or 3 things. One is we've lost a few tenders. So because of the pricing pressure, we've lost a few tenders, and also where we have won tenders in 2 or 3 player markets, we've not been able to convert our market share effectively. So the steps we are taking is more, we've done a cost optimization exercise so that we can be more aggressive in the forthcoming tenders. And also we've kind of worked with the channel and the wholesalers and the pharmacists to increase the attractiveness of the Torrent products to them so that we can get better market share where we win tenders. So unfortunately, the next series of tenders will not really come before October. So, I don't expect any short-term turnaround in the next quarter or 2. But as new tenders come up, we would be well placed to win, I would say, more share in them as compared to the recent past. So that's how we are planning to remediate.
Got it. Sure, sir. Thank you so much for answering.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Anubhav Agarwal from Credit Sales. Please go ahead.
Hi, guys. Good evening. First question, just trying to understand the US price erosion 19%. So we had a quarterly sales of 35 because of that. So if this is a portfolio average, so this implies in some products we should have seen erosion of 40-50% as well. And we are not a company where we have a very high product concentration. So just trying to understand this 40-50% erosion in certain products. Is that permanent, or was it like some companies were having inventories, they dumped it, and this was one of pricing, or has that become a new pricing? Sanjay sir, can you explain the background of what this very high price erosion?
Yeah, Sanjay, you want to make that? Yeah, you go on, Sanjay.
Correct. Actually, just to highlight what are the products behind this, right? So number one product that is responsible is a product called Nebivolol. So Nebivolol is something that we had approval since a long time, and we launched it in last quarter, and it was essentially a 4-player market with good pricing. In the end of December, middle of December, we had 2 additional players come into the Nebivolol market, and that actually brought down prices dramatically with some adjusting stock adjustments to be paid to the customers. So as a result of which, that was the number one factor. The second factor I would say is we had also launched one of the Sartans at a decent price. And then again, there were new players that came into the Olmesartan family of products, because of which there was a dramatic price reduction. So I would say there have been a disproportionate price reduction on a few products, which has resulted in this happening.
Okay. So this is the new base effectively.
Yes, Anubhav. I would say so.
And where have been gaining volumes because 35 going to 31. So you've been gaining volumes as well. So can you also mention the product where you get there?
So on a portfolio basis, our volumes last 4 years have been between 375 and 400 crores. So we are still running at the same run.
Okay.
So the mix changes, but overall the size of the volume of the business has been fairly consistent.
A question on the US business, which is Exxon. So just to understand it, you have tentative approval and you have a settlement date. 18th of February, you can launch it without any ifs and buts, right?
No, the GDUFA date is on 18th of February, so we need the FDA approval on the 18th to be able to launch the product, and we have a settlement in place. Yeah.
So don't you have a tentative approval on this? It is Exxon 7.5% share.
Correct. Yeah, exactly. We have a tentative approval, and we expect the final approval on the GDUFA date.
Understood. Okay. And and this is back to Sudhir, sir. So just trying to understand this rate increase. I did not follow this when you said that Omicron surge related disruption. Can you elaborate on this?
Yeah, it's basically on the international trade. I mean, in some of the pockets like Europe and Brazil, we saw the prices, I mean, the freight costs going up substantially, I would say. And that's because of the availability of space, the airspace, which was much, I would say, lower compared to quarter two. So there was some disruption we saw during quarter three in terms of the availability of space, and therefore the air freight shot up like anything.
And what you're seeing now, has that somewhat moderated or still running very high?
No, it will moderate, Anubhav. That's the feedback which I'm getting internally in terms of our procurement guys talking to the agents, and we believe they should come back fast to the normative level, Anubhav.
And when you said the manufacturing volumes are lower in this quarter, what led to that lower manufacturing volume?
Yeah, so it's basically, I mean, the change of product mixes which has been happening for the US, I would say. So there was some plan which was made in terms of maintaining some level of inventory, and the product mix is changing because of the contracts, the new contracts coming in for some products and some products going off, and that caused a reworking. And we saw that quarter three, the manufacturing volume really came down than what we had planned in the beginning of the year.
Okay. And just last question for Raman. Actually, so when you talk about 400, 500 field force expansion in India, can you also give some indication where are you adding these people majority? Is it to your star therapies like cardiology, CNS, etc., or are you adding them to the newer therapies that you want to grow, etc.? Is the objective to increase doctor coverage, etc.? Can you just give some high-level idea?
Yeah, this would be predominantly for the existing focused therapies, so CVD, CNS, gastro, and so on. And this would per division add up to maybe 30-40% increase per division in coverage with this new strength. So the idea is to expand. Now that we've reached a fair level of market share within the covered universe, the idea is to go beyond the covered universe. That's where the expansion has been conceptualized.
Okay, so let's see, per division you are almost adding 30-40% increase. So are these guys? Are you really going to launch so many products in this division, or how are you going to make these guys productive?
No, it would be a mix of both. There would be new launches as well, and also coverage expansion it would be for the existing products as well. So let's say in CP coverage, we will be not as high as some of the top players in each therapy. So we're trying to now catch up to that. Whereas in specialty coverage, our coverage is 100% in all specialties that we focus on.
Okay. Thank you, Aman. I'll join back. Thank you.
Thank you. The next question is from the line of Shriram Srinivasan from Goldman Sachs. Please go ahead.
Hi, good evening, and thank you for taking my question. Just the first one on the India business, can you just split out into the growth of 15% into price, volume, and new products? Just whatever is the AIOCD equivalent that you quote.
Yeah, so the AIOCD growth is 15%, volume is 4.4, price is 8, and new products is 3.
Got it. So in the past, we have talked about maintaining this, 8% price increase, and I think earlier in the call we have spoken about similar increase in next year as well. So, is there any impediments you think that could alter that scenario? Is volume growth sufficient enough for you to think that there is no demand issue?
No, I think this range should continue. Again, every year we'd have to look at the comparative scenario, but within this range, plus minus 1.5%, I think is something that we think should be sustainable.
Got it. And just one follow-up last on the India business is on the trade generics. How is it progressing? What is the contribution in the quarter? What are some of the dynamics you're noticing in this segment?
Yeah, so we've stabilized at about 2% of total contribution to the India business now. This is based on the first phase of SKU launches, and we'll be planning an equal number of SKU launches sometime next year. So this 2% should hopefully increase in contribution as we go along by the end of next year. But this base is now stabilized, and I think we've reached this level fairly quickly in a sustainable way.
Got it. Second question, and I can stop after that, is on the R&D costs, right? So QOQ they have come off. I know year over year they're up. But how should we look at this, and where are we filing some of our newer ANDAs from? How do we manage it, given that our 2 plants in India are under this one? So how should we look at that and R&D costs?
Shyam, I think R&D costs, I think at least for the next 1 or 2 years should not be more than 6%, is what my guess is.
Okay, and your filing strategy?
Sorry, filing?
Filing strategy, where are we filing the next products from?
No, so it will continue from Indrad and Dahej. There's some portion of R&D which anyway will continue every year.
Mm-hmm.
But the majority of in-house development which is happening will be filed from Indrad and Dahej only.
Got it. Thank you and all the best.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Kunal from Edelweiss Financial Service. Please go ahead.
Good evening, and thanks for taking my question. So since you mentioned it is very difficult to pinpoint when the FDA will clear Indrad and Dahej plants, have you made backup plans for high-value launches like Revlimid or any other launches you may have in the pipeline?
So for this particular product, it's not being manufactured at Torrent. So I can tell you that. And then for some of the other products, we have alternate sites in planned. But I don't know. I can't say more than that, but except that for certain high value products, we have backup sites. Yeah.
Sure. Also, could you just share your debt numbers, at the end of Q3, and how much do you expect to pay down in the next, 3 quarters?
So I think overall, in terms of repayments, we've done roughly 750 crores. And I think by March, we should be close to 900 in terms of repayment.
Sure, sir. And any sort of similar number should we expect in FY23?
Yes. It should be around 900 to 1,000, yeah.
Okay, got it, sir. Thank you very much.
Thank you. The next question is from the line of Aditya Khemka from InCred Asset Management. Please go ahead.
Yeah, hi, thanks for the opportunity. Sanjay sir, other than, so you're also experiencing raw material price increase in Brazil as well as American products. So in Brazil, are we able to take price increases to set off the raw material pressure?
Sure. Avijay, in Brazil, we have annual price increases approved by the government in April of each year. So generally, price increases are divided into three categories of products. What you call the most competitive product, moderately competitive, and then less competitive areas. So just to give an example, in April of 2021, the government allowed 10% for, I would say, very competitive products, 8.4% for medium concentrated or medium competitive, and 6.7 for highly concentrated products. So that is, and generally most companies take these price increases. It might vary product to product based on the quantitative scenario, but you can generally expect 6 to 8% price increases on average, depending on how your portfolio is split amongst the concentrated and non-concentrated slabs.
Understood. And for the US market, I understand new product introduction will obviously help you to overcome some margin pressures. But is there any scenario in which you envisage passing on the input cost pressure on a given product to its customers? So I am alluding to price inflation in the US generic market. Is that at all a possibility, or that is completely ruled out?
I would not rule it out, because at some point it becomes unsustainable. So the choice before the manufacturer is either to discontinue the product or to pass on some price increases. We have seen that when faced with uncertainty of supply of high volume products, the customers are a little bit flexible. Not very, but there's some degree of flexibility to secure supplies of high volume, I would say, products. So you can actually work with them and, with some back and forth, there can be smallish price increases to offset increasing costs of input materials.
And would that be determined by the competitiveness as well as the volume, or just the volume is enough?
I would say, the competitiveness is always a factor, right? If they can get it cheaper from somewhere else and some other larger, reliable suppliers are not willing to pass on the input price increases, that would be a factor in the decision making. But, there comes a point when everybody is faced with the same pressures. It's not a question of efficiency. Inefficiency is just a question of basic material costs and what are you recovering over them. So I would say that, there are several products where we benchmark our costs and they are in line with the best in class. So if we are facing the pressure, we can be pretty sure that others are facing also.
Got it. And sir, sorry, just a clarification on the Brazil response that you gave. So 6, 8 and 10 was the last time the price increase that they gave to less mild and intensely competitive products. This time around, is the expectation of a similar sort of a thing, or do you think, given the raw material inflation, the ministry will be more conducive to a higher number?
So, all honesty, we don't know, but generally the factors that we take into consideration is the inflation rate and the exchange rate, right? Because Brazil imports most of the APIs that go into the pharmaceutical manufacturing and the local inflation rate. So our expectation as of today is it would be fairly similar.
Understood. Thank you, Sanjay sir. All the best.
Thank you.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Sales. Please go ahead.
Yeah. Question to Aman. Aman, basically with this expansion of 400-500 reps, and assuming the portfolio grows by 10% plus next year, so you think that productivity should be maintained around 10 lakhs level, right?
Yeah. That there may be a temporary dip for maybe a quarter or two, but overall level, this level of productivity should be maintained by the end of next year, I would say.
And how do you think can this be a more regular phenomenon for you? Like, for example, you can maintain this productivity at this level and keep whenever needed, keep expanding your sales force, or even this is roadmap is very clear for next year, but on a medium period, how are you thinking about this? When you would have done your analysis, what is the need? Have you done an analysis that by adding, let's say, right now you're expanding the field force by 10%, but if you were to expand by 20-30%, you could get much higher growth, etc.
So it's a function of two things essentially. One is the increase in number of doctors every year. Since we haven't really expanded for quite some time, we were covering a very large amount, but that kind of natural expansion would need to happen. And second would be part of the portfolio when there are new launches coming in. So next couple of years, we anticipate a good number of launches similar to last year as well. So those two would be the key driving factors. Beyond that, expanding may not give the best results, and that would dilute PCPM as well.
Okay, very clear, Aman. Second question on this is just understanding question that when you look at your buyers today, for example, the organized pharmacy chain as well as let's say including e-pharmacies, what percentage of sales would they account today? Rough number.
Are we talking in India?
Yeah, India.
So the organized chains, including offline, online, would not be more than 5%, I think, give or take a few percent.
But their market share in the overall IPM market is already double digit, right? So, so your share is much lower, is it?
Not really. It would be almost the same. Particularly in chronic, it may be higher because chronic purchases on e-pharmacies tend to be higher. So I think it would be pretty much the same as in the overall IPM.
And then is the margins that you offer to the other guys versus that you offer to this guys, is there any difference in the offers of the margins to this guy?
No, it's all the same throughout for all distributors and retailers. There's no differentiation that we're doing.
Okay, thank you very much.
Yeah.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Nitin Agarwal from DAM Capital Advisors. Please go ahead.
Thanks for taking my question. So this is on the external R&D projects. Can you just give us a little bit more color on how many such projects are, I mean, 2, 3 or 4 things. One is how many such products have you filed so far? How many of these approvals expecting over the next couple of years? And what is the pipeline really looking like over here?
Are you referring to a particular geography or overall?
For the US.
So for the US, in fact, the number of projects is about close to 50. And it's a diversified basket of products, right? So there are products which are in dermatology, there are products which are in oncology, and there's a series of potentially CBT products, and then there are some oral solids, so it's and liquids. So it's a diversified basket. And our goal is, not so much linked to the number of ANDAs. The number of ANDAs generally, we used to do close to 15 to 20. Now we are doing somewhere closer to 10 per year. But the complexity and the cost of per ANDA has gone up. We are doing products which, for example, in oncology, we have a new onco site which is coming on stream, and we'll be filing the first 3 onco products in the coming year. We are doing products which require inpatient studies, these studies, so kind of expensive, difficult to do. So the portfolio mix is evolving continuously, and it's more trending towards, I would say, more expensive, more risky, and projects, but a smaller number of projects.
And I was trying to understand on how many of project filings that you've done so far are through partners?
Through partners, I would say as of today, we have about 5 to 6 filings. So we have 3 products which are approved. So one year,
Okay. And how many do we expect approvals for this year? To the extent, I guess these approvals can potentially come through without FDA inspection.
About 3. We expect about 3 approvals in the coming year.
Okay. And lastly, I think sort of called out Dapsone launch in Q4. When you look through your potential launch calendar over the next 4 to 6 quarters, how many such reasonably high value approvals or other launches do you foresee?
So it's hard to predict, right? So it's based on a lot of factors. But generally, I would say in a normal year, we should expect about low single digit 3 to 4 such launches.
And sorry, and this will FY23 qualify in your estimation to be such a normal year?
No side issues, basically. That's what I was referring to.
Okay. And sorry, so going forward, how are you looking at this partnership? How important is this partnership for your incremental R&D filings, the pipeline going forward?
So every year we try to do, let's say, 3 to 5 projects, and in areas where Torrent doesn't have capabilities or infrastructure. So that is the kind of trend that we would continue.
Okay, thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. As there are no further questions, I will now hand the conference over to Mr. Sudhir Menon for closing comments.
Yeah, thank you, Nirav, and thank you everyone for joining Torrent's Q3 FY22 call. If you have any follow-on questions, please feel free to contact me or Sapan, or drop in a mail in our investor services email. Thank you.
Thank you very much. On behalf of Torrent Pharma Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line. Thank you.